Hello, people, and welcome back to another one. Today, we have a very, very special topic. We're going a little bit off now. My mouse turned off. There we go. Now, we're going to a little bit of a special... I wouldn't call it special, but basically, as you should have seen in today's title, the topic of today is the relationship between cryptocurrency, blockchains, and whatnot, and banks. What is the future of this? What could it be? What is it now? What are thoughts? What are ideas? What was it in the past? Like the past 2 years-ish, not too far since cryptocurrency is still relatively wise, still relevantly fresh. Now, so we're gonna get started, and we're gonna start with a little bit about banks using crypto. So, anyways, the bank industry's relationship with crypto has evolved from skepticism to a deep structural integration. So, as of early 2026, the focus has shifted away from just like buying Bitcoin or just buying tokens, buying XRP or buying Ethereum, to going toward tokenization of a sort by using Bitcoin to move traditional money and assets instantly. Just really quickly before we continue, just want to mention, since we refreshed the channel, I still have to say this: I'm not a financial advisor. What you do with the information is what you do with it. You got to trust yourself, and remember to always fact check stuff. I believe my information is 100% accurate, honestly, but you should still fact check. Do not believe everything immediately. Anyways, let's get back to this. So, anyways. It's been moving toward tokenization rather than just buying stuff for profits or just holding, right? So using blockchain is now being used to move traditional money and assets instantly. So basically, here's how major banks are currently using this technology. Internal digital currencies, which such as essentially deposit tokens, instead of using public cryptocurrencies like Bitcoin. Several banks have created their own deposit tokens. These are obviously digital versions of the money already in your bank account, but they live on blockchain, so they can be moved 24/7, 365. Such as JP Morgan and Chase. Their JPM coin or token recently rebranded under one of their, I believe it was Connexies division, whichever. That's a topic for another time. It was one of the most successful ones that banks had, examples of banks creating their own token. So it allowed corporate clients to move billions of dollars instantly, and between branches worldwide. So in 2026, they expanded this by launching JPMD. It's a deposit token that works on public blockchain infrastructure. And another example of banks doing this is HSBC, and they have been a leader in Project Ensemble, which is a live pilot in Hong Kong using tokenized deposits for real-time treasury management. They are expanding the service to the US and UAE in the first half of 2026, and basically these are two big examples of big banks, bank companies using or creating their own tokens based off of blockchain technology and based off cryptocurrency to expand their services and basically quicken up their efficiency in moving money, sorting it, and whatnot, just monitoring it, etc., etc. So basically, moving on to another next thing, institutional custody, and you guys are gonna have to, you're gonna have to. What is the word when you want people to put up with you? It's like not put up with you. Bear with me. Yeah. You're gonna have to bear with me. I'm still getting used to everything. I'm gonna have minor reworks up in here and there. Yeah. So everything's still coming in. It's still coming. I think I got it. I think I got it. Now, anyways, back to the topic. So mouse is turning off again. What in the world is going on? Everything's like floppy. It's because I broke the adapter. Being too rough with it. But anyways, let's go to number 2 of the stuff with how major banks are currently using the technology, blockchain, and cryptocurrency. So, institutional custody and trading. Banks are increasingly acting as like sort of the vault for digital assets. So they can't really control it, but if they create it, they can hold it, sort of like how they're holding on money. And so for a long time, banks were hesitant to hold crypto due to regulation, being that there was no regulation. Well, not no regulation, but they couldn't control it. They couldn't govern it. But anyways, new frameworks like the OCC's 2026 rules have made it easier, and they've been more willing. So like BNY Mellon, however you pronounce it, as the world's largest custodian bank, they have integrated digital assets alongside traditional stocks and bonds, allowing institutional clients to hold Bitcoin and Ethereum in the same place that they hold their other investments. So the banks are sort of adapting. They see that cryptocurrency cannot be controlled. People don't want that because obviously not being controlled or governed by the government means more security. Their money is theirs, like it can't be touched, as I've said multiple times before in the past 2 videos. So they're adapting in the way that they're allowing people to hold it in their places. So essentially, it's still controlled by the people, but the banks still have a use in terms of their effect on cryptocurrency, what they do with cryptocurrency, how they interact with it, that people can hold their cryptocurrency in the banks. Now, it's a bit iffy. I'm not too sure whether they can, they hold the assets for people if people want them to hold it. I'm not sure if they can actually touch that or control it. Like, can they, move it? Like, can they loan it out like it can regular money? I'm not too sure. That's something you'd have to look up yourself. But anyways, another thing is Fidelity Digital Assets. They provide enterprise-grade custody and execution services for institutional investors and have been a major player in the Bitcoin ETF market as for the past few years. And then another example, Goldman Sachs. So while they don't actually offer retail crypto buying, they are active in crypto-linked derivatives and have recently been vocal about Bitcoin price floors, signaling deep involvement in market analysis and institutional trading, right? So then number 3 of the major stuff, tokenization of real world assets, RWA, and this is currently essentially, how would you say it? Analogously, the holy grail for banks. It involves putting traditional assets like gold, real estate, or government bonds on a blockchain. So a big, huge example of this is BlackRock. So while an asset manager, the partnership with banks to launch the BUIDL fund, or Buildo Fund, a tokenized private equity fund, showed that traditional money can earn interest and be traded as a digital token. Another example is Citigroup. They integrated Citi Token Services, which uses blockchain to provide 24/7 cross-border payments and liquidity management for their global corporate clients. So international, here, one country to another, etc., etc. So basically, a summary of the key players for banks is JP Morgan, HSBC, BNY Mellon, Standard Chartered, and Société Générale. I believe that is French, and I have no idea how to speak French. So if I pronounce that wrong, apologies. Not that it matters. But anyways, the key crypto blockchain initiative for JP Morgan, JPM Coin. It's Kinexis, instant corporate settlements. For HSBC, it's tokenized deposit service, live in the UK, HK, Singapore, and now US. For BNY Mellon, multi-asset custody, holding BTC, ETH, Bitcoin, Ethereum, for the big institutions. For Standard Chartered, there's Zodiac custody, institutional-grade crypto storage. And then so for Société Générale, it's Euro coin vertebral, a bank-issued stablecoin tied to the euro. So anyways, the big shift in 2026, currently, and as of the early year, is that the major trend is the convergence of TradeFi, traditional finance, and DeFi, decentralized finance, as banks are no longer trying to beat crypto. Because as you know, they couldn't control it, they couldn't government. Crypto was crypto controlled by the people. So seeing that they, as much as they tried, seeing as they couldn't control it, they decided to sort of go to it, adapt with it. And essentially, to beat crypto, they're stripping the blockchain technology, the pipes, to make the old banking system faster, cheaper, and operational on weekends. So basically, they saw that they couldn't take it, so they adapted to it, and they're trying to advantage. Sort of like, you can't beat them, then join them. That kind of mentality, for the most part. Not entirely, but for the most part. So some banks weren't like that. They obviously saw potential in crypto, I'm assuming, and whether secretly or publicly went with it immediately as soon as they saw the benefit. But most banks did not. So anyways, about the future, about crypto and the relationship of banks, it's not exactly easy to predict it, because it's less about a single path and more about a set of converging forces, such as the banks not being able to beat it, so they converged with it, and they sort of joined up with using it and creating their own stuff, etc., etc. So based on the current data and experting modeling for the next 20 to 30 years, I'm gonna give you a breakdown of what a possible future looks like across 4 different major pillars, with the first major pillar being the economy from ownership to access. And my mouse once again has died. Not died, but it turned off. Oh my gosh, is there any way these why isn't it going in? What in the world? Oh, give me a second. It's not going in. Hold on, my mouse. I have notes. You just can't see them. Hold on. Yes, there we go. Oh, that is so much better. Okay, I have notes, so I have a couple notes, like bullet points that you speak off of. But anyways, so the first major pillar, the economy from ownership to access, right? So by 2040 to 2050, the concept of owning things may become a relic for the middle class, replaced by a hyper-efficient subscription economy. So it is likely that things will be tokenized, as we just discussed. Banks, your net worth won't just be like a bank balance. It'll be a digital wallet of fractionalized assets, owning like 0.05% of high rise in Tokyo. A tiny slice of a painting, and carbon credits from your home's solar output. Because with crypto is like, it's investing, but it's more than so like, for instance, stocks. You invest in stock, you're investing in the stock. Whatever that stock is connected to, like, sure, you're investing in that, but really you're just investing in the stock. The stock is controlled by other things, right? You're not investing, like, let's say you invest in a restaurant stock. You're not investing in the food the restaurant's serving. You're not investing in the chairs. You're not investing in the seats. You're not investing in the workers. Not exactly, anyways. You're investing in the business as a whole, right? Whereas crypto is like those tiny details, those tiny parts. Like you're investing into, like, let's say an art gallery, you're investing into the different parts of the painting. So if crypto becomes like the new future of like assets and finances and liquidity, it's likely that investments like your money, your wallet is going to be like owning, like, let's say an NFT. And the value of that NFT will rise and fall. So money will no longer be stagnant. Rather than having like $1 in a safe, right? You give $1 in a safe, is always $1. I mean, the value of the dollar compared to, like, let's say rupees may increase or diminish, but it's always going to be $1 in the US, right? However, with crypto, the value could increase. Maybe stuff like that, it is trending, or maybe there's more value in the usage or efficiency of a said object, right? Like, let's say you crypto for a blockchain technology. Let's say you're using, for example, XRP technology, which banks really will want to use in the future because of the efficiency and what it does as a platform and whatnot. Now, I'm not proficient on the token of XRP. I do not know really anything about it, not at all, so don't take my word on it. I know little snips and tidbits, so if you know anything about it, you probably know more than me. But anyways, its value is going to rise over time because its efficiency and usage, because it's always evolving, is going to change. So that's essentially what this is for tokenized everything. Your money won't be static. It's going to be dynamic for the future of relationship between the cryptocurrency and the banks. Now, the AI labor shift also, seeing out a hybrid workforce is kind of being input, like routine tasks, legal discovery, basic coding, data entry. It's like that these things will be handled by AI agents. And for AI to execute the manual navigation of software, cryptocurrency, blockchain technology is probably going to be a huge thing because it's essentially right now, it's the modern and most proficient as of now, not as of now, but it's evolving to be that, to be the most proficient in security and efficiency, speed, and whatnot. So if we're gonna have AI doing our labor, doing our stuff, I mean, it's already proficient with no mistakes, but people are gonna want faster. Companies are gonna want faster. They're gonna want better. They want it now. They want it saved. They don't want to get into legal trouble, so this can't be mistaken, etc., etc. So these AI agents are likely gonna be using that, right? And this could also be in the banking system as well. A universal basic services. To counter AI-driven unemployment, governments may move beyond basic income to basic services, providing automated transport, high-speed data, and basic health care as a fundamental right. Now, health. Basically, the longevity revolution. So currently we're in the early stages of shifting from reactive medicine, fixing what's broken, to proactive cellular maintenance, right? Maintenance. So the 100-year life goal, so global life expectancy is projected to increase by at least 5 years by 2050, with many scientists believing the first humans to live to 120 are already born, which is very true because we already have that, and I believe there was the world's oldest person lived to like 120 already. That was one person. It's only going to increase with time if age increases, of course, right? Syngenetics and gene therapy. Future medicine will probably involve clearing out aging cells, using CRISPR-style gene editing to prevent hereditary diseases before they manifest. And to be very accurate and to be with that, to keep track with that, the blockchain technology is going to be very efficient with that. And then overall in the medical industry, the blockchain technology, if not already used right now, is going to be big in the future, in cryptocurrency like that. What do you call it? Just because of the way it stores information as a ledger. And the different like cryptocurrencies, because different currencies obviously do different things based on the company and the platform and whatnot. And what is this? So the big thing, and I'm looking at my notes, and I feel like I really should comment this. The big thing is, because the whole topic of this is the bank's relationship with cryptocurrency. So one might ask, we just talked about a bunch of stuff that basically has not exactly, but explicitly has nothing to do with banks, like healthcare, AI. What does that have to do with the banks? Well, these industries, right, obviously have to do with finances, and the banks right now are the ones managing their finances in the health industries. If they start moving to blockchain technology, they're most likely going to be moving to cryptocurrencies, and the banks are going to be regulating that. So sooner rather than later, if banks stick to the what do you call it? The archaic way of doing this and managing money, many industries are going to start moving away from banks. Now, moving away from banks are there are obviously the workers inside the banks. Workers work the banks hire the workers. I mean, and I'm trying to make a connection. I'm trying to make like a trophic level chart, right? For what provides for what. The bank provides jobs for the way. But what I'm essentially trying to get to, I'm just going to cut the nonsense. I'm going to just get it straight. The banks are controlled by the government. And if industries are moving away from the government, away from banks, they're essentially moving away from the government. Now, of course, the government is more than likely going to control the healthcare. But if their two things aren't working together, I mean, the only time you don't need things working together is if it's for balance and checks and balances, sort of like government. Executive branch checks the judicial branch. Supreme Court government can veto or impeach the president. Not veto the president, but veto a bill. I mean, that's probably more Congress and whatnot, right? That's probably more that. But the Supreme Court can take action, right? But if it's not checks and balances, you don't want your two things moving away from each other. I want the healthcare that I'm controlling to be associated with the bank I'm controlling, right? I don't want it to be not associated, because otherwise one of them is going to be invalidated. And what's going to be invalidated is going to be the banks, because healthcare is needed for people. Banks, essentially, if cryptocurrency goes where we think it's going to go, it's not, the banks aren't going to be as useful as they were in, per se, 1890 as they were in 1950. They're going to be invalidated if they don't hop on this train, right? So that's essentially the connection. As healthcare evolves, the banks are going to evolve too. It's like a symbiotic relationship. They're very connected in that way. And then also, basically, we can head to. I think I summed up basically my thoughts on that. We can head to the third pillar. So the Great Graying and urbanization. So like the demographic map of the world is like flipping upside down. Like there's an aging population. Like by 2050, for the first time in history, there will be more people over 65 than children under 18 in many developed nations, because people are going to be living longer, of course. And then there are also birth rates, as you know, have been down. According to some sources, some people say it's up, some people say it's down, but majority speaking, most people think it's down, especially in different nations such as I think it was China it was Japan. I think it was Japan, where their population was increasing old and birth rates were down and whatnot. So anyways, there's gonna be a massive care economy where robots and the AI assist elderly increasing populations in that way on its own with assist. The rise of megacities, as nearly 70% of the world will likely live in cities by 2050, and these will just be bigger versions of today's cities. They will be like sensor cities, where like traffic, waste, and energy are managed in real time by central AI brains. So it's really this megalithic, futuristic way of thinking of the future. Oh, AI does this and this. It's a simple concept. It's not the only concept. It's not an idea, but it's really the main one. It's like the big one that people think how society is going to go, which honestly I think would be very, very nice. Personally, I'm not a financial advisor. I don't take my advice, and I say that for a simple opinion like that because like I say, you might think, oh, I should think that too, but no, you got to think your own thoughts, people. You got to think your own thoughts. You're your own person. So anyways, a fourth big pillar, moving on, the environment, like climate 1-2 punch, you know what I'm saying? The future environment is a story of extreme adaptation. So like climate volatility, even with aggressive changes, there's the expected like 50% jump in greenhouse gas emissions by 2050. This means weather. So what does this have to do with blockchain technology in the future of cryptocurrencies? Well, these cryptocurrencies are going to be funding essentially, I believe personally, they'll be running the economy, and whatever runs the economy runs essentially the cities and runs the people. It's going to run the factories and their emissions and whatnot and the climate. And what this basically is like, it's going to be what's providing solutions, right? No, actually, no. We're gonna skip that. My notes are going a little bit off. I don't know how I got here. I mean, I was a little tired doing this, but I went from possible future, right, for relation for the banks and crypto. I don't know where this came from. Like I get the great graying urbanization of future because a lot of crypto has to do with AI, a lot of blockchain technology. I mean, the relationship will be symbiotic in a very broad sense, and I feel like that's going to be very good. So I can understand me adding that, but I have no idea what any of that has to do with the climate. Like as of right now, that is not the most important thing for the relation. You get what I'm saying? So anyways, I'm going to go off of that, but those are the major pillars, and essentially, as we enter a post-scarcity era, versions of the future and how different things interact with each other are obviously going to adapt and change, and this includes the relationship between banks and crypto. Like, man, the notes. I feel like because I was trying to connect everything, right? I was going, I feel like I just said a bunch of nothing. Like I didn't, but it feels like I did because the relevance slowly went away. It was still relevance, but it slowly went away, and then you know what I'm saying. So, what are the benefits of banks moving toward blockchain and crypto tech? So it's not because they want to become crypto exchanges, but essentially because it fixes plumbing issues that have existed in banking for decades. So four primary benefits driving this shift in 2026 is 24/7, 365 operations. It's revolutionary. No more bank holidays, because let's say Christmas comes by, a bank is going to shut down. And if a bank shuts down when Christmas comes, I mean, let's say there's an emergency, someone's not getting their money, and that's not essentially great. I mean, not only is it lowers the revenue the bank could be making that day. Like the amount of money banks could be making if they went 24/7, 365 instead of taking breaks would be astronomically big. I mean, it's continuous income, right? People can do it anytime. I mean, because just because it's Christmas doesn't mean a person's not going to take money out of an ATM, right? It means like the person might take off from work to spend time with their family, but they might not take. They're still going to do other stuff, right? It's not like they're doing nothing, right? So in the traditional system, moving money, especially across borders, relies on a series of intermediary banks and clearing houses that only operate during business hours. The benefit of blockchain technology is it allows for instant settlement. $1 million transfer can happen at 3 a.m. on a Sunday just as easily as on a Tuesday morning. morning. And this frees up trapped capital that usually sits in limbo for 2 to 3 days during the settlement process. And then number 2 is radical cost reduction. Traditional banking is expensive because it requires multiple checkpoints to verify that a sender actually has the money. Right? The benefit of blockchain technology, as estimates suggest, is that it can reduce transaction costs by up to 70%. By using a shared digital ledger, which I explained in the previous video, banks eliminate the need for manual reconciliation, which is comparing 2 different sets of books to make sure they have a match. For scale, for a bank like BNY Mellon or JP Morgan, which moves trillions of dollars daily, even a 0.1% increase in efficiency translates to billions in savings. Now 3, programmable money, which is like smart contracts. Which is perhaps the biggest superpower for banks, as smart contracts are bits of codes that automatically execute transactions only when certain conditions are met. Sort of like if you're in stocks and you're on that long, I forget what the thing is called. But that like long hold or staking, is that what it's called? I don't remember, but like you said it, if like let's say the price goes to like $50, then you have it like automatically sell. I don't know if that's a thing. I saw it somewhere. I don't know if that was actually real. I'm not into stocks. I don't know anything about it. I'm not going to say I do because I don't, right? So anyways, it's basically like that, right? And then the benefit is like imagine a cargo ship pulling into a port. A smart contract would be programmed automatically to release payment to the seller that exact second the GPS confirms that the ship is docked and digital custom forms are signed. And the automation basically it removes the need for like escrow agents, lawyers, manual paperwork, making complex trade finance almost instantaneous, which is a big thing because it's not just AI. A lot of people, we're going to lose our jobs to AI. Oh, AI is going to replace us. It's not just AI at all. It's really the future of technology as a whole, because these blockchain technologies, these smart contracts and whatnot, are also going to be automating and stuff like that. Like back in the 1950s, you would have, or 40s, whatnot, you would have people writing down stuff, and they would keep it basically in here and on a page. That was sorting, that was the ledger. Then you had the digital age, so now everything was typed up. There was no longer any need for people writing stuff down. Now the jobs were still there because people could still do the stuff online technologically, but you see, if they were 2 separate jobs, writing the stuff and doing it digitally, that job would have gone out of business. It would have been erased, vamoose, extinct, no longer there, essentially, right? So that basically sums that up. So, and I honestly don't know where I was going. No, I know where I was going with that, right? But I forget the original statement to like complete it. So we're just gonna go on the 4th benefit, and that's unlocking illiquid assets. So banks make money by managing assets, but many assets like commercial real estate, private equity, or fine art are lumpy in the way that they're hard to sell quickly in small pieces. So the benefit of this is tokenization. So by turning a $100 million office building into 1 million digital tokens, a bank can sell smaller shares to a wider pool of investors fairly quickly. And the new revenue, it would allow banks to offer investment products to people who couldn't previously afford them, creating entirely new markets and fee structures, right? So I want to move on to the next point between the relationship, and that's potential profits, estimates, and predictions. So the financial industry is currently looking at crypto, specifically blockchain and tokenization, not as a speculative side bet, but that's the most significant upgrade to banking infrastructure since the invention of the internet, right? So based on 2026 projections from major consultancies like BCG, McKinsey, and Citi, or CT, it's spelled CIT. I don't know how they pronounce it. It could be Kaiti, right? I don't know. But here are estimated profits and market shifts. So the big numbers, market size predictions, these are basically goals for banks to move to real world assets like bonds, real estate, and private equity onto the blockchain, right? So there's a very aggressive view, like BCG and ARK Invest, projecting an $11 trillion to $16 trillion market for tokenized assets by 2030, which would represent roughly 10% of the global GDP. The conservative view, which is McKinsey's view, projects $2 trillion to $4 trillion market by 2030. Even at this lower end, it still represents like a massive new revenue system for banks acting as token issuers and custodians. Now, the growth rate, the blockchain and banking sector is currently growing at a CAGR of 52.8%, and it's expected to hit nearly $89 billion in direct services revenue by 2030. Now, another point is profit centers, which is where the money's made. So banks expect the value in 3 specific areas, and that's cost saving, asset custody, and tokenization fees. So how cost saving works is 90% reduction in cross-border fees, which is near zero cost for reconciliation, checking books, and the estimated impact is $15 billion to $20 billion in annual industry-wide savings by 2030. As for asset custody, which is charging fees to safely store digital keys for institutions just like they store goods, gold or stocks, right? The estimated impact is crypto custody is a multi-billion-dollar fee-based business, right? Now, finally, for tokenization fees, charging a percentage to turn a physical asset, like a building, into digital tokens, basically faster shares, more efficient shares, it could unlock a $1.1 trillion in trapped liquidity for banks, right? Because it's all the stuff that's hard to move that they were struggling with before would become liquid. It would go from illiquid to liquid fairly quickly and fairly nicely, if I do say so myself. So the efficiency gains is the next thing, number 3, which is essentially the 90% rule. And the most immediate profit for a bank is actually the money they stop losing to old, slow processes. So cross-border remittances, sending $1,000 today, typically costs around $44, 4.4%, and takes 3 days. On chain, the same transfer would cost about 10 cents, less than 10 cents even, and would settle in seconds. That is huge. Now we're talking. Now it doesn't seem like a lot because $44 doesn't seem like a lot. I mean, you're making that per hour, right? Or 10 cents. You're making that like this. If you're making $44 per hour, you're making like what $5 a minute? What is that? Like $3 a minute? That means you're making like you're making that much money per second, right? So it's like margin wise, I mean, it seems small, but $44 compared to 10 cents is like comparing $1 million to $1 billion. I mean, it's huge if you actually look at it like in terms of ratio wise, right? And then also the stablecoin market, the market for digital dollars, stablecoins, is expected to grow from $400 billion in 2025 to $3 trillion by 2030. As banks that issue their own stablecoins keep the interest earned on the cash backing those coins, a massive high margin profit play. Now, number 4 is the AI plus blockchain multiplier. So by 2030, BCG predicts that retail banks could unlock an additional $370 billion in annual profits by combining both AI and blockchain technology. Because the logic is AI handles the customer interaction and risk assessment, while blockchain handles the instant invisible movement of the money. This creates a zero marginal cost bank where it costs the bank almost nothing to serve one additional customer. And so the summary of the 2030 prediction is that the possible future that is discussed earlier is becoming a math problem for Wall Street. Most analysts agree that by 2030 we won't call it crypto banking anymore, it will just be banking. Well, not essentially. I personally don't believe that. I don't believe it's going to be called banking. Honestly, like the banking system is going to be reformed to a point where I think it's going to go from 13 colonies to be calling the United States of America, if you understand that analogy. So I had another point down here, and I think this is where we're gonna call it up. It's been a very long video. I think the information is good. I have a lot more points I would have liked to get to, but I think we've got enough, right? So I had an interesting question that I wanted to research, that I did research, and it's what might banks not want people to know about crypto, and what ideas may they have? And honestly, well, from what I got, not honestly, but from what I got, it's that while banks are publicly embracing the efficiency and profit of crypto technology, blockchain, there is a significant amount of strategic anxiety behind the scenes. And so here is what banks might not want the general public to focus on as we head into 2076. And that's the middleman anxiety. Which is disintermediation. The core philosophy of cryptocurrency is decentralization, which is removing the need for a bank, removing the need of the government or governments of our money and making things slow, or making it so that our money isn't actually there after we put it in or when we want to take it out. And so the secret fear is that if you can send money directly to anyone in the world for just 1 cent, using a public blockchain, the bank loses its reason to exist as a toll booth. right? And so the response is that banks are building private blockchains like JP Morgan's currencies, right? And these allow them to use attack while keeping themselves in the middle. They want to increase the efficiency of crypto without the permissionless nature of it, right? So it keeps the banks alive, convinces people that banks still have a use, and also increases their profit. Because otherwise, if they just allow crypto to run free and wild, it's predicted and most likely, based on reasoning facts and what's happening and what's crypto and blockchains have done, that banks would go extinct, vamoose, they would be gone, their jobs would not be needed, and that's a loss on a part of the government, right? That's a loss in control. So number 2 is that digital bank runs would be faster. In the old days, a bank run involved people standing in line at a physical building, while in 2023 in Silicon Valley, we saw it happen via smartphones. The hidden risk with blockchain-based banking is that money can move at the speed of light. If a rumor starts, an entire bank's deposits could theoretically vanish in minutes. So what it's essentially saying is if people figured out, like, there's more security with this blockchain technology, there's more security with this crypto, why am I holding my bank in the money when I could do this? And a bunch of people figure that out, they can take a whole bunch of money, right? Just take it out on them all at once because they're all in this. It's sort of like mass hysteria. Mass hysteria, everyone thinks is one thing, and it starts a whole thing. It's a domino effect. It's a domino effect, like domino theory. A whole thing. They start thinking, and it could cause a bank to completely fail if that happened, which wouldn't be good for the banking industry, right? So the deposit can theoretically vanish in minutes. And then also the kill switch. So banks and central banks are quietly designing programmable limits into their digital currencies. And they might not advertise it, but they want the power to limit how much you can withdraw during a crisis to prevent a total collapse. Which honestly is justifiable, because if people find out about this and they're just taken out, as you know, that's how inflation happens. That's how stagflation, how prices start rising, a whole mess. It can ruining a nation. I mean, hyperinflation is already happening in other places because of reasons like this. It's happened in the past because of reasons like this, and it could happen in the future like for reasons like this. And that's not what they want. That's not what we want. We want the industry going. We want profit. We want profit, profit, profit. We don't want any risk. We'd like to reap the rewards, and we'd also like to keep our country running, right? We'd like to keep our jobs. That's essentially what I think they're thinking. So the end, we're going to go to the third point, and that's the end of financial privacy. Because cash is anonymous, bank-led crypto is the opposite. The idea is that when a bank issues a deposit token or government issues a central bank digital currency, CBDC, every single transaction is recorded on a ledger they control. The surveillance angle. Banks, and by extension, the government, could theoretically see not just that you spent money, but what you brought in real time. They are exploring programmable money, which could in extreme scenarios be restricted. For example, this digital coupon can only be spent on groceries, not alcohol, right? And then we're going to get to the fourth point, which is hidden spread fees. So banks often advertise zero fee crypto trading to compete with apps like Robinhood or Coinbase, right? So the catch is that they make their money on the spread, the difference between the buy and the sell price. They might buy Bitcoin at $70,000 and sell it to you at $71,000, calling it a commission fee trade. In 2026, these hidden spreads can often be more expensive than the old school flat fees, right? So it's sort of like a trick, like it cost me $5 to make this product, I'm gonna sell it for you 10. I'm making profit, right? And I'm not losing anything, and then also you're getting the thing you wanted, etc., etc. You know how that works. Number 5 is what we would call the honeypot risk. So by bringing crypto into the banking fold, banks are creating massive honeypots for hackers, right? The strategy, so banks claim that their institutional grade security is better than your personal cold wallet. However, if a bank's private keys are ever compromised, the scale of the theft would be historic. They are insured, but the reputational damage could be systemically threatening because everything's going to be held in one place. I mean, how many keys is a bank willing to use? 100? I mean, 10? I mean, 1? I mean, 1,000? Are they willing to use that? How are they going to keep up with it, right? How far are they willing to go with the security? And then how far is a hacker willing to go to make that quick money? Because all of it's going to be in one place. If it's using blockchain technology, it's all going to be linked together. If a hacker can get through to one, it's going to get through to everything. So if this institution, if their security, right, is undermined once, not only is the theft going to be great, but people are they're going to see that it's not worth it. They're going to go away from the banks. So they really have to they really have to keep that under the water. They can't really have that known, etc., etc. So, for example, what they say versus what they think. I don't think we can go over that, but I think that's where we're gonna end it for now. I think that's I think we went pretty in depth with that. I think the knowledge went pretty in depth. I feel pretty good about it. But anyways, that basically, I believe, sums up all my points. Not all of them. There's a lot more, but I'm not gonna make an hour video. I'm still small, you know. People aren't gonna watch me for an hour because they don't even know. They're probably not even gonna make it here. But that basically sums up my ideas and what I think could be or anything really associated with the relationship between crypto and the banks, whether it's the future, the past, the present, etc., etc. I hope this information was useful. I tried my best to explain it. I'm still not the most proficient at explaining because, you know, I'm new to this, but hopefully I will get better, and, you know, that is that. Now remember, I'm not a financial advisor. This information is what you do with it. I hope you enjoyed, and I will hopefully see you in the next one.